All right, today is excuse me, Wednesday, March 26th. This is the 12:30 p.m. section. This class is being recorded. Today, what we're going to do is we are going to pick up where you left off on Monday with the BMW valuation. Okay. And essentially, we are going to finish today what's called an as is valuation, which is basically valuing BMW as of its current share price today. Okay. And in order to do so, you're going to need the file that you submitted on Monday ready to go. So while you get that ready, I'm just going to do a quick check-in to remind everybody that for the Bloomberg Trading Challenge, you must be below $300,000 worth of cash by end of day Monday. Okay. And if you are not below 300,000 as of end of day Monday, you will be disqualified. And you'll get a zero for the rest of the semester with no exceptions and no extensions. So make sure you start trading, because I looked a little bit earlier in the last section today and almost nobody's bought anything. So I'd start buying and start getting out of cash and get into the marketplace. So there will be no more reminders of this. And essentially, I'm very serious about this deadline. Okay. So any questions about the Bloomberg Trading Challenge? Great. All right. So just as a reminder of where we left off, on Monday, make adjustments to something real quick. Okay. So this is the file from Monday. So what we had done is based on these ratios coming true, right? We created these income statements and these balance sheets, which created these cash flows. Let's just see if for BMW and these economic profits and ROICs, right? What we're going to do today is we're going to do an enterprise DCF valuation based on this model. We're going to put in more realistic data for BMW, and we're going to match their current share price today. That is a process known as an as-is valuation. And as a bonus, if you were in this class right now and you are able to follow along, you can submit homework 9 by 2 p.m. Eastern Standard Time. You will get 1 extra credit bonus point for the semester. So instead of a 2-point assignment, it will become an extra bonus point, and you will get 3 points for completing the assignment successfully. If you do not submit by 2 p.m. today, then just like everybody else, the assignment is due on Monday at 10 a.m. and you get the normal 2 points like everybody else. But I do believe that there is extra credit sometimes in showing up. And since you guys actually were willing to show up today, I am giving the opportunity for semester-wide extra credit if you were able to do what I do and submit your model by 2 p.m. Eastern Standard Time today. Okay. Questions about anything before we get started?
Does that apply if you are in the class before this but couldn't make it, so now you're in this recording?
Anybody that submits by 2 p.m. is good.
Okay, thank you.
But after 2 p.m., the deadline shuts down. And I'm not publicly announcing this other than on the video. And so people watching the video after 2 p.m. should have come to one of the 2 classes that were available today. But you still get your normal credit, so it doesn't hurt you. Can't hurt your grade. This is only helping. All right, any other questions? All right, so let's begin. So we're going to start turning this into an enterprise DCF valuation. So down here, we're going to add a new worksheet, and we're going to call it DCF, discounted cash flow valuation worksheet. Right? And make it a little bit bigger so it's easier to see. All right, so following Modigliani-Millet, operating value plus non-operating value is enterprise value. Operating value is driven by free cash flow. So we need to look at the free cash flow value forecast for BMW to get its operating value, right? So we're going to start out on the new valuation tab, cell B1, free flow. Our first year of forecast, A2 equals assumptions. Last reported year, assumptions B2 plus 1. So our first forecast year is 2025. We forecasted 6 years. The first 5 years of the year-by-year forecast, year 6 is the beginning of the perpetuity period. So what are the free cash flows for the next 5 years? So A2 plus 1, carried down 3 more years to 2029. So I need our next 5 years of free cash flow forecast. Well, those are going to come from the CFI. So on our CFI, it's a little bit bigger. We have a forecast for free cash flow for 2025 starting in column H. So our column H, 2025 free cash flow forecast is this number right here. So on the DCF, 2025 free cash flow forecast equals CFI H 14. For 2026, our free cash flow forecast equals CFI I 14. For 2027, our free cash flow forecast J 14. For 2028, our free cash flow forecast from the CFI K 14. And our 2029 free cash flow forecast equals L 14. So assuming our assumptions come true, our ratios, assumptions, forecasts come true, these would be the forecasted, and I'm just gonna, for consistency of formatting, make these 1 decimal place. The next 5 years of free cash flow in euros that BMW is expected to generate. Okay, but those are the next 5 years. If I'm going to do a valuation, I need the value today. So we get a present value all of this. So we know the formula for present value is cash flow divided by 1 plus R to the N or T. So what we're going to do is we're going to take the cash flow and multiply by 1 divided by 1 plus R to the N or T, and that's called a discount factor. And if we multiply our free cash flow by our correctly spelled discount factor, we get our discounted free cash flow. So discount factor equals 1 divided by left paren 1 plus the R. In this case, the R from the assumptions is the WACC. So assumptions B4, right paren. So if I take the free cash flow and I multiply it by that discount factor, present value of that free cash flow, which again, formatting purposes, one decimal place, 16,458.1 million euros. Okay. And I'll just shrink this a couple to make it a bit easier to look at. All right, so I'm about to copy this down to essentially discount the next 4 years. But before I do, I want to make sure that that WACC is an absolute reference. So put a dollar sign in front of the B and a dollar sign in front of the 4 in that formula in C2. Right, and I'm going to take C2, copy it, go all the way down to C6, paste it, except in the second year, it's 1 divided by 1 plus R squared. So at the end, shift 6, 2. Third year, it's 1 divided by 1 plus R to the third power. Shift 6, 3. 1 divided by 1 plus R or to the fourth power for the fourth year, shift 6, 4. And 1 divided by 1 plus R to the fifth power, shift 6, 5. So free cash flow times discount factor is discounted free cash flow. These are the present values of those free cash flows for the next 5 years. And if we were to sum them up, then we get the operating value, free cash flow value, in first 5 years. So that's just the sum of E2 to D6. So again, if our forecast comes true, BMW will generate 62,726.6 million worth of euros of value in the first 5 years. Questions about anything that we just did? Pretty straightforward. All right. So what we then will do is we will go into what's called continuing value. Right? Because the company doesn't end, BMW doesn't stop at the end of year 5. It's going to continue long term. All right. So we need a terminal value or a continuing value. To do a terminal or continuing value, we will use the formula for the key value driver formula. So we're going to put in a continuing value. And just so we remind ourselves, this, take a quick screenshot of it and put it in here so you remind ourselves of what we're about to do. This is the formula This is what's called the key value driver formula, which we've been using all semester. Here. There it is. And we're going to use this formula for continuing value. Right? So that's the perpetuity value formula. So we need four values for perpetuity. We need a continuing value no plat. We need a continuing value G, which is the long-term G of the company. We need a continuing value ROIC, which is the average ROIC long-term for BMW. And we need a WACC, which we already have. Now, because this is going to be a reusable model, instead of hard coding it here, I'm going to start putting them here under the assumptions. So this would be the continuing value no plat. So next assumption, the continuing value ROIC and the continuing value G. And these will all be in yellow. So for continuing value no plat, this off the TII is our no plat. And this is year 6, which is the beginning of our continuing value period. So as we talked about in the last class, we always do an N+1 year. And that final year is the beginning of the continuing value period. So in our case, 2030 is where the continuing value period starts. So in 2030, the starting no plat is M5. So on assumptions, continuing value no plat as a starting point equals TII M5. And again, for formatting purposes, now we need a continuing value ROIC. Same thing. Equals from the economic profit tab, ROIC after goodwill, row 16, continuing value period, column M. So M16. 5.1% approximately is our continuing value ROIC as a starting point. Now, we're going to use this as a placeholder, right? Obviously, we want something that's representative of the long term, but nonetheless, that's where our model says the long term starts. And then we need a long-term G, and we're going to start with 3%. You're going to say, why is he putting in 3%? And the answer is because most European and US economies grow approximately 3% a year, 2 to 3% a year GDP long term. And most mature companies tend to grow with the economy over time. Okay, so we're going to do a starting point. Now we're going to try and put a more reasonable BMW G later, but I think 2 to 3% is a good starting point placeholder for our model. If I were doing, for example, a Chinese company, I might start at 4 or 5%. Okay, whereas if I'm doing a German company, I might do 2%. Right, but again, I'm looking at BMW multinationally, 2 to 3%. Most Western countries that they're selling to with their economy as a starting point. Okay, but the point is, this is the hardest thing you're about to do today's class. Is we're going to put those 4 values into that formula in that cell. So in valuation B10, I'm going to see if I can get the order of operations correct the first time. So equals left paren, working off the assumptions. No plat times left paren 1 minus the growth. So B7 divided by the ROIC, B6, right paren divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren, enter. So if, and I'll put the formula here. Oops. If those assumptions come true, BMW will generate that value in continuing value for year 6 into perpetuity of free cash flow, discounted essentially to the beginning of year 6. 63,661.3 million. But we're doing a valuation today. So I don't need a year 6 value. I need a year 0 value. So I got a present value. So January 1st, because year 6 has already been discounted with that formula, by the way. You don't want to double discount, common error people make. So January 1st is basically the same as December 31st. So we're going to use the same discount factor as the end of 29 to bring it back to present value. So in a present value basis, year 6 value times the discount factor says today, that's worth 47,571 million euros. So the operating value, global operating value, of BMW is the first 5 years plus the continuing value, or about 110 billion euros and change. Questions?
I just want to make sure I have this right. You have C10 just relative reference to C6.
Correct.
It's fine. Okay.
Because this formula, essentially because the WACC is in it, is discounting the perpetuity value. And it discounts it to the beginning of year 6. So year 6 has already been discounted. And all the years after that in that formula. That's a discounted perpetuity value as of the beginning of year 6. But we have to bring this back to today. So that's what I'm saying. January 1st, year 6 is the same essentially as December 31st, year 5, which is that value. So we're going to discount it again by those 5 years to bring it back to today. We don't want to double discount year 6. That's why we're using the same value as year 5.
Could you show the formula for B10 again?
All right. So Modigliani-Miller, operating value, which we just calculated in present value, plus non-operating value equals enterprise value. So now we need the non-operating value for BMW. Here is where all that economic statement work we did will help us. Because on the TFI, we have identified the non-operating value of the firm because we have identified the non-operating assets and the non-operating liabilities. So they are from the TFI.
Sorry, before we can continue, do you mind telling me again, how did you get the operating value?
How did I get the operating value? We just added D8 and D10. Add those two numbers together, you get that value.
Oh, okay, thank you so much.
Non-operating value, these are the non-operating assets and liabilities. So if I copy A10 to A12 off the TFI, those are the ones that would get us the non-operating value of the firm off the balance sheet. Okay. So let's move this over. So here's the thing. For this, we're going to use the last reported numbers, which are already in present value. Okay. So for excess cash equals off the TFI, which we've done, the 24, which is the last reported year, which column G, excess cash, G10. Right now, they got about 19 billion euros of excess cash. Non-operating assets equals the TFI, negative 16 billion, G11, and they have long-term investments of TFI, G12. 12. And again, I'll just format that to 1 decimal place. So the total non-operating value today, already in present value, of BMW equals the sum of these three numbers. 60 billion, 21.4 million euros. Assuming all those ratios come true. We're just adding up those three numbers right here. Sum of those three. Okay, operating plus non-operating equals enterprise value. So we are then forecasting an enterprise value of BMW equals the 110 plus the 60, approximately 170 billion, 319.4 million euros. Questions? All right, operating plus non-operating equals enterprise value. Debt plus equity equals non-operating value. So here's the point. If we take the enterprise value and we subtract off the debt, we're left with the equity value. If we subtract off the non-common equity values, whatever's left belongs to the common shareholders, common equity value. So basically that's what we have to do. We got to pay off everybody else first. Common shareholders get the residual. So again, this is where TFI helps us. Who has to get paid? We have to pay the retirement related liabilities. We got to pay the interest bearing debt. We got to pay the preferred shareholders, the minority shareholders. Whatever's left goes to the common shareholders. Right? So retirement and interest. So let's copy all 5 of these. And get rid of common equity. All right, so those are the 4 stakeholders that had to be paid off, and the residual belongs to the common shareholders. So again, this is where TFI helps us. What do we owe in retirement related liabilities today? Well, again, off of column G, TFI, we owe 222 in retirement. We owe 106 billion euros to the debt. Preferred shareholders, TFI, we don't owe anything, but might for another company. So that's G18. And for the minority shareholders, we had to pay them back off the TFI. G19. So those are the 4 stakeholders that would have to be paid off in order to solve for a common equity value of BMW. So we're going to take our enterprise value and we're going to subtract the sum of these 4. So we are estimating a common equity value . We are estimating a common equity value of 61,355.4 million euros. Again, assuming all of our assumptions come true. Questions? All right. And then if we know the shares outstanding, and we divide the common equity value by the shares out, we are left with a model share price or a forecasted share price. Now, the shares outstanding is something that could change company by company. So as I was telling the last class, I gave you Burger King next week for your next homework assignment, then you need Burger King share count, right? If I gave you Nike, you need Nike share count. So that could change as the company changes. So I don't want to hard code it here. So I'm going to go to the assumptions, and the next assumption down is the shares outstanding. That's yellow. And what we're eventually going to try and do is have our model match the current share price of BMW. So we're going to need that too. Now, here's where we're going to go to Bloomberg. Okay. For every assignment going forward, you're going to need 3 screenshots. You're going to have to turn in those 3 screenshots. And if you don't turn in those 3 screenshots, you're going to get a 0 on the assignment. So you're going to write a minimum 500-word paper. If you don't turn in a 500-word paper minimum, you're going to get a 0 on the assignment. Okay. So very important. Take screenshots, write paper, submit Excel model. Okay. Don't just submit the Excel model. Now that's different for homework 9. For homework 9, you don't have to submit the screenshots because I'm only asking you to do the same file that all of us are doing. And I'm going to show you what screenshots you're going to need, which is your roadmap for your future assignments, because we'll need them to complete the BMW assignment homework 9. But since we're all going off of my screenshots, you won't need to do screenshots for this assignment, but you will starting next week. All right, so back to this. Shares outstanding. If I go to Bloomberg, there are 3 screenshots that you will always get. Let me share. Screenshot number 1, DES. The reason for screenshot number 1 is right here is the current shares outstanding for the company. Makes it easy. Okay. So basically, shares out 579.8 million shares. Right. The other reason for screenshot number 1, the DES, is when you do your as is valuations, this share price from this screenshot will be the one that you will try to match. Right now, it would be 79.28. But just to be consistent with the 11 a.m. section, okay, so I'll take this as a screenshot. All this my BMW DES. Right. So we need this screenshot. And so I'm going to take the other 2, but we're going to use the data off the screenshot. Second screenshot you're going to need is we're going to need a more realistic WACC for BMW. So you type in WACC and you'll get the current WACC for the company. Right now it's 5.2%. Our model says 6. We're going to eventually have to adjust that to 5.2. So again, we'll take a WACC screenshot. And the third screenshot you're going to need is EEO. This is the consensus estimates for revenue and EBITDA going forward from the sell side analysts, which is the average of all their guesses. Take screenshot, save, EEO. Those are the 3 screenshots you're going to need as a minimum. And there might be a 4th. So we'll talk about that in a minute. So we'll always need these 3. So I went ahead and took them now. All right, so going back to the model. Stop. So shares outstanding from the screenshot in Bloomberg today, that was on the DES screenshot, which I'm just reading off of if you're in the lab following along, 579.8. And for current share price, we're going to use the same share price that we did in the 11 a.m. section. And the 11 a.m. section, it was trading at 80.48. So let's put in 80.48. Now it's gone down since then. All right, so if this were the real assignment going forward, homework 10, you'd use the share price at the time you did the screenshot. But just for consistency for this assignment, because we all have the same numbers, 80.48 is what we're going to use for the current share price in euros. Okay, so back to this. Now we're going to go back to, oh, the valuation should be the last tab in the model. All right, so shares outstanding equals, from the assumptions tab, B8, and model share price equals the common equity value divided by the shares out, 105.82.
Sorry, do you mind showing that last formula again?
Which one?
Model share price.
D27 divided by D29.
Thank you so much.
All right. Now, curveball. BMW is a little bit more complex. And it's one of the reasons why I chose this company. BMW is 50% owned by a family and 50% owned by the general public. So half that share price belongs to the family and half the share price belongs to the public. Okay. Now, this is not common, right? But there are companies like Google, which has two classes of stock, or Facebook, which has two classes of stock. And if you have a two-class company, you'd have to value each class of shares separately to get the total value of the company. All right. So for BMW, it's a 50-50 split. So this is the total value of BMW. Okay. But the actual share price that is in the real world, so the half owned by public share price, so this part is not part of the reusable model, is basically that divided by 2. So 5291 is comparable to the 80. Does that everybody follow? So again, this is all of BMW, 100% of BMW, but half of that belongs to the public, the other half to the family. And we are only valuing the public half of BMW. Now, what we're going to eventually try to do, and this is the whole process of the as is, I'm going to put it here, is we are going to have the current share price, which is 80.48, that's the half. And we're going to have the model share price, which is the half. And those two numbers have to match. So we need to get to 80-48 in our model, approximately. Right? So that's our next step in the process. But again, before we do, questions. All right. So these assumptions assume that 24 repeats itself. Now we had to put in some more realistic assumptions. So let me shrink this a little. All right. So let's start putting in some more realistic assumptions. What's going to drive our valuation most is the operating value of the firm. Those non-operating assets aren't going to change that much. It's the assumptions we make for the operating value, that's the real value of BMW, that's going to drive the share price, which means free cash flow. All right, two parts of free cash flow, gross cash flow. Well, see these cells in gray? These are the three most important things to forecast gross cash flow. Growth, which is revenue, EBITDA, tax rate, that's basically forecasting your free cash flow, your gross cash flow, essentially your no plan. Okay. Gross investment is your balance sheet. This is the other benefit of doing everything as a percentage of sales of the operating assets on the balance sheet and operating liabilities. As we grow the balance sheet, because everything down here is a percentage of revenue, then the balance sheet grows automatically in our model. If the balance sheet, if revenue grows, balance sheet grows, revenue shrinks, balance sheet shrinks, everything stays constant productivity. And you can see that the productivity is similar to the historical productivity. So it's kind of growing at a fairly reasonable rate, right? Most companies stay within a range for productivity over time. If you think it's going to change, you can always make forecasts to change, but nonetheless, for the vast majority of companies, you can kind of leave the balance sheet alone, right? And just focus on the income statement. And there's really three drivers. So the 80-20 rule of valuation is get these three drivers right. Everything else kind of takes care of itself. That's what's critical to the valuation. Okay, so that's what we're going to focus on. We need a realistic tax rate for BMW. We need a realistic growth rate for BMW, and we need a realistic EBITDA margin forecast for BMW. Let's start with the tax rate, right? Here's where we'll go back to Bloomberg. The analysts, sell-siders, trying to do the exact same thing we are. They're building Excel models at Goldman Sachs and Morgan Stanley that look a lot like the models that we have here today. Okay, so then the question is, what tax rate are they using for BMW? Well, the company sometimes will give guidance. So in Bloomberg, GUID. If the company gives tax rate guidance, it would be on the guidance screen. BMW does not give tax rate guidance. If you use the tax rate guidance from the company, screenshot number 4, BMW-GUID. Just an example, if you go to a company like Walmart, here's their guidance. Walmart actually does give tax rate guidance for what they think the tax rate is going to be in long term, 24%. They're telling the analysts 24% is what you should use in your models, right? And most analysts are going to use 24% because Walmart's not going to tell them something they don't think is true, right? But BMW does not. So the analysts have to figure it out for themselves. So if the company gives guidance, use their guidance, take a screenshot for tax rate. If they don't give guidance like BMW, then option B is go find out what the analysts are using. So go to BRC, and these are the analyst reports we have access to. And I would recommend starting with JP Morgan, because I know in JP Morgan, they always give tax rate guidance. They put in their reports. Matter of fact, is that a question? So right here, on March 19th, there was a JP Morgan model update. This is their spreadsheet model that they're selling to their investors. And if you open this as a PDF, which you have access to, this is the actual research report where they're calling BMW a buy. And you can search this report for the tax rate guidance. So right here where it says search tax rate, the PDF. Yep. And right here in the report is BMW's forecasted tax rate by JP Morgan. And what they're using in their out years, starting in 26, is a 25% long-term tax rate. So in your case, bibliography, source, JP Morgan, analyst report, 25% tax rate. Again, you don't do this for this assignment because we're all using 25%, but that's where we're going to get our long-term tax rate. Option 1, guidance. Option 2, JP Morgan. So, close out the screen.
Can you just show how to get to that again?
Just go to BRC. For the company, go to the company first, then go to BRC. This is Bloomberg Research, basically the analyst reports that we have access to because they sell these. We subscribe to be able to get JP Morgan. Look for a recent JP Morgan, or even Deutsche Bank might have one, but open up a recent JP Morgan report, and where it says search, we can read the report, but search keyword tax rate, and it'll search the PDF. And so that's the point. JP Morgan's trying to do the exact same thing we are, and that's what they're telling their clients they're using. They're using 25% in the long term. All right, so back to our model. So what we're going to do in our valuation is we're going to change the tax rate instead of 29.8 long term to 25. Notice that that's going to raise the model price. The other thing we're going to do is we're going to go to assumptions, and we have a 6% WACC. But as we saw in the screenshot, today's WACC for BMW is 5.2. We're going to make sure we update the WACC. Well, that's going to change the share price to 82.47 for our half of the company. Now we're starting to get more reasonable. So we update the WACC, we update the tax rate. Now we got to put in more realistic revenue growth rates and EBITDA margins. Here,
Oh, sorry. What did you change the WACC to?
5.2 from the screenshot.
Okay, thank you.
Share. So here is the third screenshot we took, which is EEO. In the EEO screenshot, this is the forecast for revenue for the next 4 years. This is the forecast for EBITDA for the next 4 years. If you take EBITDA divided by revenue, you get EBITDA margin. If you look at the change in these revenue growth rates, which you can either do here, there's the revenue growth rate for the next 4 years. Or we need 5 years. So we just go down here to the bottom, move over one column, and there's the 5th year of 2029. Okay. So this data is what we need to get the growth rate and the EBITDA margin. Okay. So here's how we're going to do it. So I'm going to go back to our model. Under the assumptions tab, starting in equals last reported year plus 1. And for the next 4 years thereafter, so equals B11 plus 1. and copy this to 2029. We're going to use the consensus from the sell side analysts. Revenue. And the consensus EBITDA to get the consensus EBITDA margin. Now these cells are going to be yellow because they're going to change company by company. Now, unfortunately, I can't share both screens at the same time. So I have on one side of my computer, I have the screenshot from Bloomberg that we just took for the EEO with the consensus on it. And the other side is the spreadsheet that I'm sharing with you. So I'm just reading off the consensus, which you could do in the lab if you're in the lab. So in 2025, the consensus revenue estimate for EBITDA is 147,487. 147.487 million euros. In 2026, 151,217. In 2027, 155,763. In 2028, it's 161,375. And scrolling over one column in Bloomberg, so back to Bloomberg and scroll over a column. The consensus 2029 revenue forecast is $167,810. For EBITDA, since I'm in 2029, the consensus EBITDA is 22,844 in 2029. So I'll work backwards. In 2028, the consensus EBITDA is 22,075. In 27, it is 22,857. In 26, it is 22,089. And in 25, the consensus EBITDA, back column, is 19,950. So hidden in plain sight, take the EBITDA divided by the revenue, EBITDA margin of 13.5%, growing to trouble today. %13.6% over time. That's the consensus for BMW for the next 5 years EBITDA margin, based on the analyst estimates today off the EEO. It's baseline. And we're going to use that for our as is. So basically, if I go back to my valuation, or sorry, my ratios, these numbers, which I'm now going to unyellow, are going to be these numbers. So for 2025 equals assumptions B14. And then just copy and paste that over. 2020. Questions about what we just did? All right, same thing with growth. They're not going to shrink 8% a year. You can clearly see they're expected to grow. So the formula for revenue growth rate is current year minus previous year divided by previous year. So in 2025 equals left paren, current year revenue is assumptions B12 minus last year's revenue off the income statement, actual, is income G3 divided by income G3, 3.6%. In 2026 equals 2026 revenue, which is assumptions C12 minus last year's revenue, 2025 revenue, assumptions B12 divided by assumptions B12. They're expected to grow 2.5%. In 2027 equals left paren assumptions D12 minus C12 divided by C12. And since we're working off of that, we just copy these over. I don't like when the Mac has a spinning ball. It always makes me nervous. Okay, there it is. Let me save this before something catastrophic happens. All right, so those are the next 5 years of revenue growth rate based on the consensus that from the analysts, and those are the 5 years of margins based on the analysts. Which, by the way, gets our share price to 122 for our half of the company, and we need to be at 80.48. Questions about what we just did? Do you need to see anything?
Can you go through the revenue growth rate again?
What's the formula for revenue growth rate? You tell me.
It's the current year minus the previous year over the current year.
All right, so in 2025, our current year is 2025, right? So assumptions B13 minus 2024 minus income G3 divided by previous year income G3. That's the formula. And that's up. Now, the only difference is when we get to 2026, we don't need historical data anymore. Now we're just doing 2026 revenue minus 2025 revenue divided by 2025 revenue. So for this one, I was working off of here. 2026 revenue minus 2025 revenue divided by 2025 revenue. For 2027 revenue minus 2026 revenue divided by 2026 revenue. That's the formula. So I'm just solving for it. Now you could have gone to Bloomberg and you could have just transposed the growth rates because Bloomberg's already done this for us. But I'm just being detailed here. But we need the revenue growth rate. We need the EBITDA margin forecast for BMW for the next 5 years, which we put in. All right. So we put in a tax rate, put in EBITDA margin, put in the revenue growth rate, and we're trying to match 80.48, and I got to cut 40 euros off the share price for my half of the company. So I'm still a little high, right? So what's left to cut? Well, I can cut my 2030 growth rate, and I can also cut my G. Okay. So the problem is I don't think the market thinks BMW is going to grow 3% a year. All right, so let's assume that long-term, they think that they're kind of flat. 0. No growth long-term. So starting in 2030, just no growth long-term. They're not going to grow. Well, now I'm at 98. I still got to get to 80. So I think what the market is really saying about BMW stock price today is they don't think this is the perpetuity margin. They think their EBITDA margins will be lower in perpetuity than 13.6%. That's the way they're trading today. No growth and lower margins very long term. So we got to figure out what is that low margin. So generally there's 2 ways to do this. You could use goal seek, which for some reason wasn't working for me in the last class, maybe it will now. Or you can essentially, if you don't use goal seek, you can manually iterate. But we're going to iterate the margin until those 2 share prices essentially match. Okay. And see if I can get goal seek to work. So what I want to do is I want to set cell the model share price to be 80.48 by changing the margin. Yeah, see, it doesn't, I don't know why it's not liking what I did. Probably because I divided it by 2. Anyways, long story short, do it manually. If you do it manually, what you're going to end up doing is you're going to get a number that looks like this. Let's cut this to 13. Let's cut this to 12. Let's split the difference. Now I'm in 4 cents. So what the market is actually saying is they think BMW's long-term margin is going to be approximately 12.5%. I saw a hand up there a second ago.
Can you hear me, Professor? Hello.
I can hear you.
I think I changed the 2030 growth rate to 0% and I got a different price, but it was right until then. I think I might have. Did you do one more thing?
Make sure you have the CVG at 0%. That's the important. Because
Okay,
that's 2030 is just a 1-year growth rate. 20 CV row B7, that is a forever growth rate. That's the one that's really going to matter.
okay, that worked. Thank you.
Yeah. So what I'm saying is my scenario that explains the current share price of the as is essentially no growth and slightly lower margins. That's the way BMW is being priced today. And when you do the as is, you're trying to model the current share price. It's not whether you believe that that's what the share price is going to be. That's called the target share price. That we're going to talk about on Monday. Okay. This is what the price is today. We got to explain the price today. And right now, the market is not trading BMW as if they have a lot of long-term opportunity. Right. Now, in the last class, people iterated a little bit further and it's like 12.49 ... and they got their goal seeks to work. So if you get a number within a few cents of 80.48, I'll consider that okay. But if you do 80.52, that's the one I'm looking for right. So just put in 12.5%. This is homework 9. If you've gotten to this point, submit it. You'll get your 2 points. And if you submit it by 2 p.m., you'll get an extra point. You'll get 3 points towards your. If not, you have between now and 10 a.m. Monday to submit this file to get to the 80.48 share price or 80.52. Which remember is half the company. Okay. Because the real value of BMW is twice that. The real value of BMW is like 161 a share. Right. So the real value of BMW is 94 billion euros, but the public only is entitled to half of that because the family owns the other half. So you split it in 2. So this is a little bit complicated, a little nuanced, and most companies don't do this. You value Costco, you just got one class of stock. Price is the price. You don't have to do this weird half company stuff. But I thought I'd throw a little bit of interesting in there with a real company that you heard of and show you a little bit of the nuance.
Could you show your assumptions tab again?
So don't do this half price thing if I give you like Costco next week. I'm not going to give you a company with dual share classes for your next assignment.
Can you show how you got your enterprise value, please?
Just format something while I'm here. Something specific about the enterprise value you want to see?
Was it always 202,000 or was it smaller before and you changed something to make it bigger?
It was smaller because remember, in the original homework you did, we had BMW shrinking 8% a year. We're not doing that anymore. And so when they keep shrinking 8% a year, the share price is going to be lower. It's a lot less cash flow. So even where we started, the cash flow has grown the last 30 minutes as we put in more realistic assumptions about their future. But this is the assignment. This is homework now. So again, if you've gotten to this point, submit that by 2 o'clock. If not, submit it by Monday, 10 a.m. TAs have office hours. TAs will have a copy of this file. I am not handing out this file. You have to create this yourself. And on Monday, we're going to finish up by doing a target valuation, a Bull Bear, and some sensitivity analysis around this for a buy, sell, hold opinion. And then we'll talk about how to get data from Bloomberg to reuse this model to do another company. And then next week, I'm going to give you another company. You're going to do it all by yourself without me.
Sorry, can I see the DCF valuation tab one more time?
Sure. Anything particularly you wanted to look at?
Just the continuing value and then just the operating.
The operating values, the first 5 years added up. Continuing value was that key value drivers formula that we plugged in here. Notice it's grown because we now have a 5.2 WACC instead of a 6 WACC. That raises the value of the company. And I think our ROIC is slightly higher than what it was before when they were shrinking 8% a year. So that continuing value is 155 billion. We started out around 60. And so the model's dynamic. Every time you change the assumption, these numbers are going to change. That's the point. All right, I saw one question in the chat. Somebody asked about this. So margin is just put the revenue, put the EBITDA divided by revenue, EBITDA margin. That was the consensus because those were forecasts. Year by year, analysts think on average, because averaging all the analyst guesses, that they're going to be. This is your file. By the way, just as a preview for Monday's class, if I go here to ANR, where BMW today is 79, it's fallen since we started this. The analysts actually think on average that BMW is worth 88 for their half, for the public half in the next 12 months. So their spreadsheets show with their assumptions, what they think will happen, share price of 88. So they think there's 11% upside. That's called a buy. So that's how you get a buy at BMW. But that's the point. There's 11% upside. It's not huge on the next 12 months, but it's the long-term value. The way they're coming up with this upside is they think that the margin's probably not going to fall as low as what we just put in the share price. Because that's the point. To get to this share price in a DCF, they're not getting a lot of credit for a good long term. And that's not in their track record. Something's got to get worse for BMW in the long term than it's been in the last 10 years. And even the next 5. And so they see a buying opportunity. Maybe it's just they're being swept up with this global sell-off with all of this trade war stuff. And so now you buy them on the dip. I mean, that's probably what some of these analysts at Bernstein are telling their clients. You know, BMW just went on sale. You want to earn 10%, buy them now at this price. But hold on to it because you're on a little short-term roller coaster. Whereas Grupo Santander is like, nope, we're worried about BMW's future. So again, differences of opinion. That's the target model, but that's Monday's class. All right. This has been recorded on a video. The video will be posted hopefully shortly. Should use it again. And for those of you watching on video, you have until 10 a.m. Monday to match this, get within 4 cents of the share price, or put in the model of this share price. And again, you won't get copies of this. I'm giving copies of this to the TAs, and you don't have to turn in the screenshots for this one. But starting next week for your homework 10, you will have to start turning in screenshots. I'll be very specific about that in the assignment. So other than that, make sure, again, back to Bloomberg Trading Challenge, by Monday, get out of cash, start buying things. Whether it's ETFs or stocks, you want to go short something, but get out of cash. Got to have less than 300 by end of day Monday. All right, everybody. Homework 9 is available to submit as of now. If you get it by 2 p.m., you get 1 extra. Have a good rest of your week. See you on Monday.